My name is Ron Feldman, and I'm the Head of Supervision, Regulation, and Credit at the Federal Reserve Bank of Minneapolis. And today I'll be talking about banking conditions in the third quarter of 2011 for the 700 commercial banks that are headquartered in Montana, North and South Dakota, Minnesota, the Upper Peninsula of Michigan, and the western portion of Wisconsin. These are the states that make up the 9th Federal Reserve District. In short, conditions improved for these banks, but they're not back to where they were before the financial crisis, and the progress that the banks made varied across the financial metrics that we think are important. So let me summarize the overall condition of banks, and I'll provide more detail into these points. First, we saw the greatest improvement in the asset quality of these banks. And by asset quality, what I mean is measures of how timely and fully the borrowers are repaying the banks. We saw less of an improvement in the profitability of these banks, and their year-to-year loan growth remains negative, although it improved a little this quarter relative to last quarter. In terms of liquidity and capital, these banks are doing pretty well and are continuing to improve. And by liquidity, what I mean is their access to funding and their ability to sell their assets to raise funding if they need it. And capital reflects the financial resources they have to absorb losses. Finally, I'm going to talk a little bit about how our states vary. The bottom line here is that the Dakotas and the banks in the Dakotas are doing better than the rest of the district. The Twin Cities and Montana, and perhaps to a lesser extent Minnesota overall, are doing worse than the rest of the district. So let's provide a little more detail on asset quality. Here you're going to look at a measure of loans that aren't paying on time and in full relative to financial resources the banks have to absorb losses. And you can see that the third quarter of 2011 had a strong improvement. And by strong, I mean the quarterly change was relatively large to quarterly changes we've seen over the last decade. This was driven primarily by commercial real estate. These are loans that are secured by commercial real estate that are made to firms. It's these kind of loans that stopped performing to the greatest degree after the financial crisis. And we're not going to see an overall improvement in the performance of loans until these loans start improving their own performance. In contrast, profits rose only a little bit this quarter. Now, why is that? In part, it's because banks are having fewer loans on their balance sheet, and the other assets that they hold, like securities or deposits with the Federal Reserve, don't earn as much money. And in part, it might be because expenses are rising a little bit for some of these banks, perhaps because they have to comply with additional regulation and supervision. Let's move to looking at the actual data on loan growth. Here you can see that it remains negative. That is, the loans on the balance sheets of these banks are lower than they were a year ago. Now, the actual level is less negative than it was last quarter, but as long as it remains negative, it's going to be a drag for banks. Liquidity and capital are also important measures of the condition of banks. And I could say in sum that the liquidity of these banks remains quite strong across a number of measures. Same to their capital position. And here, some of the banks actually, for example, have more liquid assets now than they did before the crisis. In sum, there's been some improvement of the financial condition of these banks. There's some areas where they're doing strong, but overall, the improvement is not enough to get them to where they were before the crisis. Now, how do banks compare across our states? Really, what we see going on is that banks in the Dakotas, North Dakota in particular, are doing much better than the rest of the district, and in particular doing better than banks in the Twin Cities, Minnesota, and Montana. You see this most starkly when it comes to asset quality. You can see here that the Dakotas have a much lower level of bad assets relative to their capital and other resources to absorb losses than the Twin Cities. Now, the gap between profits across the states is not as strong, but you see the same rank ordering. So what we've seen in the third quarter is improvement, but we're going to need to see more improvement along this line before we get back to where we were before the financial crisis. And we're not seeing uniform improvement across our states and across financial metrics. Thank you.